Auditing is all about systematic examination of books of accounts. Auditors check for the operations of a business. So how effective that the measures that the companies use, whether the accountant or the management of that particular company is telling them truth or lies. The auditors use various statistical tools for analyzing the financial statements, whether they are true or not. Hello everyone, I am Nikhila with ES, Faculty of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. Welcome to the fourth session of the first unit, that is Introduction to Auditing. So today we are going to discuss about the relationship of audit with other disciplines. As we all know, auditing is all about systematic examination of books of accounts. So auditing is not just a subject which is only confined to the audit or verifying the books of accounts. Rather, it is a multifaceted discipline that intersects with other various fields for enhancing its effectiveness and broadening its scope. So by collaborating with other disciplines, auditing ensures a more comprehensive evaluation of the organization's operations and finances. So, let us discuss what are the other fields or subjects or disciplines that intersects with auditing, or what are the areas that the auditing subject has relationship with. There are many other various disciplines that has relationship with auditing. These include accounting, finance, law, management, information technology, economics, statistics, ethics, taxation, corporate governance, environmental science and psychology. So now let us discuss how auditing is connected with these subjects. So first and foremost we have is accounting. As we all know, accounting is all about collecting, classifying and summarizing the financial data or the books of accounts. It involves all the financial transactions which are material to the business. So collecting those financial transactions, entering, summarizing them to make informed judgments. So the subject of auditing is inherently linked with the subject of accounting, as auditing involves verifying and examining these financial statements or books of accounts. So the financial statements are prepared by accountants and they are verified and examined by the auditors. The auditors rely on accounting policies, principles like generally accepted accounting principles and IFRS, that is International Financial Reporting Standards, in order to ensure that the financial statements are in compliance with these accounting standards. So in that way, the auditing is related to the accounting. For example, auditors review the financial statements of a particular company that is prepared according to the standards of accounting by the accountants of that particular company. So next we have is finance. So finance includes the assessing of a company's, or it's the work of a financial manager to assess that particular company's the decisions regarding capital budgeting, capital rationing, or finding the sources of funds and usage of those funds, etc. So here in auditing, the auditors oversee the financial decisions of a financial manager, whether the company's capital budgeting is good, or they check for the company's portfolio management. The auditors are going to verify and check the valuation method that is used for assets and liabilities, and they are going to conduct a trend analysis on like how the fund flow is managed in a business. Financial management includes setting up of proper internal control techniques in order to see that the finance of the business is managed well. And here the auditors see that or they check for the internal control system that is used by the financial managers in the business. For example, an audit of a company's investment portfolio. Here the auditors checks whether the investments are recorded at fair values or not. And the auditors assess the risk associated with them. Next we have is law. So every company must adhere to certain rules and regulations or the laws of that particular land or the country they exist. For example, Income Tax Act 1961 or the Companies Act 2013 or the Companies Act 1956 or MRTP Act, Competition Act, like that. So here the auditors ensure that the company adheres or it's in compliance with these particular laws, whether it is securities laws or incorporation laws or tax laws, etc. So understanding these legal framework helps the auditors to identify the potential transactions that may lead to the legal implications or litigations. For example, during an audit, the auditors may check for the compliance of that particular company with the Sarbanes-Oxley Act, which has some specific rules for the financial recording as well as the auditing for the publicly traded companies. So next we have is management. So management is all about planning, organizing, staffing, directing and controlling the activities of the business. So basically the main objective of management is to enhance the efficiency and effectiveness in the functions of a business. How it is related to the auditing means, here the auditors check for the operations of a business. So how effective that the measures that the companies use or how effective and efficient that the internal control system in the organization is. So the auditors provide decision-making support to the managers. So by providing various insights, suggestions or the recommendations based on the financial position of a particular business, the auditor also helps the managers to take proper decisions. For example, while auditing, the auditors may identify some of the inefficiencies in the supply chain management of a particular business. So they can recommend the companies to improve the effectiveness or the operations of supply chain management in that particular company. So next we have is information technology. So with the increasing reliance on the technology that is used in the business, there is necessity for the IT audits to be done. The IT audits assess the integrity, security as well as the efficiency of the information systems that are used in the business organization. And the auditors use many data analysis tools and technology for analyzing the large financial data. For example, an IT audit may check for the security of enterprise resource planning system or ERP system of an organization. So next we have is economics. So how auditing is related to economics? See, a business organization is affected by both internal factors and external factors. So the internal factors of a business are the factors within a business organization which can be controlled by the business management. So these factors affect the operations of a particular business, whereas external factors are external to the business but affect the business. So here the economic condition of that particular country also affects, or it is an external environmental factor that affects a business or a company. For example, the GDP growth rate of that particular country or the exchange rate or the economic condition of that particular country, etc. For example, the financial crisis that happened in 2008 affected the stock market and many companies closed down and faced losses. So this is how the economic condition of that particular country is going to affect the businesses. So here the auditors consider various economic conditions and indicators that affect the financial performance of a particular business. So understanding the market trends and economic condition of that particular environment helps the auditors to assess whatever the assumptions or the forecasts that are done by the financial management of that particular company. So next we have is statistics. So statistic involves collecting, analyzing as of numerical data. So here the auditors use various statistical tools for analyzing the financial statements, whether they are true or not. For example, the auditors use the statistical or the sampling technique in order to evaluate the overall performance of that particular function in the organization. The businesses will have large number of transactions that happen on a daily basis, and the auditors cannot check each and every transaction. So they'll just select a sample of transactions that represent the overall effect or efficiency of that particular function. So these statistical methods and techniques help the auditors to analyze the financial data better. So for example, during a financial audit, the auditors may use a random sampling technique to select the sample of transactions in order to check the sales of that particular business. So next we have is ethics. So ethics is all about the moral values, beliefs that we individuals follow. It says us what is right, what to do and what not to do. So here the auditing profession is also guided by ethical code of conduct in order to maintain the integrity and the accuracy. So the following of ethical code of conduct is also important for the auditors to maintain that independence, objectivity and integrity in their profession. The auditors also assess whether the organization complies with the ethical standards or not. And in the next we have taxation. So here the auditors assess whether the company is following the rules according to the tax laws or not, whether the company is filing proper tax return or not. So it is necessary in order to ensure that the company pays a certain as per the rules, a certain amount of corporate tax to the government. The auditors may evaluate the company's tax planning strategies as well as their adherence to tax regulations. For example, an audit might reveal the errors in the tax computations of a business, and the company may need to make adjustments in the tax returns. And next we have is corporate governance. The corporate governance is a set of rules and regulations and policies that guide the organizations. So how the organization should be run and administered. Here the auditors evaluate the effectiveness corporate governance, various rules and policies and regulations that are set in the organizations. And the auditors interact with the board of directors and board committees in order to check the accuracy of the books of accounts and their decisions on the financial statements. So next we have is environmental science. So here it tells all about, for every business organization, it lives within an environment. So it is an obligation and social responsibility of every business organization to protect its environment. So it should not harm the environment and its surroundings. The companies must follow the environmental regulations that it has based on its operations and functions. For example, particularly the waste management system that is there in the organization. So it should not dispose the waste that is produced in a factory or a company directly to the river and spoil the natural resources of the environment. So it must adhere to the rules and regulations of the environmental regulations. So here the auditors assess whether the company is in compliance with these environmental rules and regulations. The auditors also review the sustainability reports of that particular organization. For example, an environmental audit might check for the waste disposal and pollution control rules and regulations and its compliance or the company's compliance with these rules and regulations. And at the last we have psychology. Understanding the psychological factors is also important for the auditors in order to identify whether the accountant or the management of that particular company is telling them truth or lies. So understanding the human behavior and the corporate culture helps the auditors to identify frauds and errors. So the relationship of audit with all these disciplines underscores its interdisciplinary nature. So by integrating the principles of these various disciplines like taxation, psychology, environmental science, or the finance, the auditors offer a holistic approach to the evaluation and assessment of the financial statements. So this was all regarding the relationship of audit with other disciplines. Hope you all have understood. Thank you.